morning, everybody, and welcome to our national Q&A call. Today is the 14th of March, 2023. It is 9:02 a.m. Pacific, 12:02 p.m. on the East Coast, and we're going to get started right now with news you can use. Everything has changed. In the last 3 or 4 days, the world has turned itself upside down from an economic and financial standpoint. There's a lot to unpack today. We'll just go through it piece by piece. First of all, you guys probably have seen that we've had 2 banks fail in the United States. The first one was Silicon Valley Bank last Friday, and then over the weekend, Signature Bank was seized by the FDIC, Federal Depositors Insurance Corporation. There's a run on the banks, an old-fashioned, old-school, everybody standing in line to take their money out, run on the banks. Why? Well, that goes back a couple of years. Some of it has to do with decisions that some of these banks in particular made. Bad decisions, perhaps. I don't know. Time will tell, or history will tell. These guys got themselves involved in things like cryptocurrency, and they loaned people to hedge bets in crypto. And a lot of the banks that are in trouble are focused on high tech, specifically the high tech area of Silicon Valley in the United States. And you guys have probably seen, we've talked in the past about a lot of these tech companies are laying off people. So there is some big problems brewing the tech industry aside from all this. Nonetheless, there were 6 banks that were downgraded today to a watch or a imminent fail position by the rating agency Moody's. There's going to be a bunch more. While all this was happening, the Fed and the federal government over the weekend had to come up with something to keep everybody from running to their ATMs and going to their bank immediately and taking all the money out. Now, in the past, we've kind of discussed some of the changes also at the banking level that have probably led to this situation. Number one is during COVID, actually March of 2020, so 3 years ago now, the Federal Reserve lifted or removed from the requirements that a bank hold either in their own vaults or at the Fed, hold 10% of all their depositors' cash on hand for a run on the bank. If all the banks did that, there'd be enough to cover the runs that a few banks would have before the government could stop the run of the banks. They lifted that because of COVID. They wiped that requirement out, and they've never put it back into place. So the banks are short on cash. The economy is short on cash. The Fed playing their shenanigans, and you guys know my feeling about these things, about the Fed in particular. These guys have changed the rules, and they've been bending the rules to try and accommodate what they wanted to do, not what was best, in my opinion, for the economy, either ours or internationally. And as they raised rates ad nauseum last year and are getting prepared to do it again this year, they've been kind of playing over here and keeping their eyes off of the real game in this situation. And, they've slipped, in my opinion, in their oversight of some of these banks. So they've allowed some of the banks to do some more dangerous, tricky things that wouldn't have been allowed, but, fit into loopholes. So they allowed them to do them. And now the chickens have come home to roost. And so some of these banks are no longer going to be able to function, at least effectively. Some of them are being sold off. In fact, Silicon Valley Bank, which was the 16th largest bank in the United States and the second largest ever bank failure of all time, is on the auction block by the Federal Reserve and FDIC, actually. And they're going to be auctioned off this Sunday. So these guys are not messing around. The Fed, though, had to do, and the Treasury Department in conjunction, even though in theory they're supposed to be independent, is they agreed to pay all the depositors back for all of the monies they had on deposit. Now, the way that the rules work here in the United States is every account is guaranteed by the Federal Depositors Insurance Corporation. Every personal account is insured up to $250,000. Well, a lot of these people in Silicon Valley have millions of dollars in the bank. And, anything above 250 would have been lost in a bank run when they had to shut down a bank. But what the federal government did is they stepped in and said, we will cover all depositors for all amounts to the total last penny, and we'll make it available today, which was yesterday. They said that over the weekend. Now, hats off to them for making that announcement, because that probably stopped a total collapse of the economy that would have happened today or tomorrow. They were able to stop that because people said, we don't have to worry about it. The federal government's going to go in and cover everything. But just like in 2008, They didn't say they're going to do that with any of the other banks at this point in time. Now, as a practical matter, with Signature, First Republic's on the precipice, Credit Suisse, and there's 4 or 5 other banks, they're going to have to go in and guarantee those assets to all of the people to keep from the economy totally collapsing into a total, not just a recession, but a depression. This is a real problem. The government essentially now has spent, according to the numbers I saw last night, $185 billion over the last 3 or 4 days. And this is printed money. This is quantitative easing. So all they do is they print the money out of thin air and then they cover the depositors, and that makes these depositors whole. So it's a really bad situation because the $185 billion is done without congressional oversight. There's nobody in the legislative part, which is supposed to, essentially approve all taxes. The Senate and the House of Representatives have to weigh in. Of course, the president has to sign or be overridden on his veto if he doesn't for something to become law, but we bypassed that step entirely. Now, this was done also in 2008 during the Great Recession under the Bush administration. They basically gave out, all of this money, part of the $787 TARP bailout that they had. They didn't like to call it bailout, but it was a bailout, just like this money right now is a bailout. But remember, there was only about $200 and $300 million of that $780 billion. $200 to $300 billion went to the banks to save them out of the 787. We've already spent 185 in basically 2 days. So once again, this hasn't on a broad scale hit the news yet. It will. And, in my opinion, you're going to see a lot of activity as a result. Now, what's happened with regard to our business, the housing business, as a result of all this stuff? Well, number one, the mortgage rate, the average 30-year mortgage rate dropped over a half a point from a little over 7 to a little over 6.5 in the last 48 hours or so, actually since Friday. So 4 or 5 days now. And it will continue to drop. It's also put the Fed, the Federal Reserve, in an extremely bad position between a rock and a hard place. Now, they've indicated, because inflation has not been reduced, or has been reduced, but it's not been reduced enough. They've indicated they were going to not only continue to raise interest rates, but they're going to speed that up. So the consensus was that they were going to raise the interest rates by 0.25% next week at their meeting here in March. And right before this all happened, as a result of their meeting a week or so ago, when they came out and said we're going to raise rates faster and higher, the indication was they were going to go up 0.5%, which basically would have put, at the time we were at 7% interest, that would have put interest at about 8%. It would have totally shut down the housing market. So be this as a blessing or a curse with regard to these banks failing, this is probably going to tamp those interest rate increases down. The market is betting on no interest rate increase next week. And if they let a few more banks go over the cliff, we will see a flat out falling of interest rates. They'll have to drop, because for every percentage point that they increase, or 25 basis point increase, it's going to cause billions of dollars of damage to the gross national product. So you have a choice. Do you get inflation under control, or do you save the economy? And I think they're going to have to vote for saving the economy. I don't think there's any other way to get around that. Now, in the housing business itself, it's going to do 5 things as far as we can tell right up front. Number one, consumer sentiment has dropped to, basically an extremely low level with regard to buying homes. People think, I think it was something like 80% in a survey that was done a couple of weeks ago, say it's a bad time to buy a house. And that was before all this happened. So general consumer sentiment is going to be dampened, which is going to reduce home buyer demand. That's not good. So if our buyers are sitting on the sidelines because they want to see what happens with the economy, that's going to happen to us. Number two, tech-driven housing markets like Austin, Seattle, San Francisco, those things are toast. They're gone. Boom. Just like that. Markets in San Francisco are repricing their FSBOs and listed properties as we speak. They were already off 20% over last year. They're probably going to drop another 20% or so. So if you've got a home in San Francisco, It's going to be worth about 60 cents on the dollar by the time this thing's done. Number 3, mortgage rates could go lower. That's a good thing for us. And my belief is they will go lower. And keep in mind, mortgage rates don't directly tie to the Federal Reserve. They tie to, or very specifically, they tie to the 10-year T-bill, which has been dropping. When that drops, then interest rates for mortgages drop. So I think you're going to see those things drop. And my opinion is, as that's the key to this whole thing, when mortgage rates drop, more buyers come off the sidelines. Even if they think it's dangerous waters, they're willing to put their toe in. They're willing to go after and look for a new home. And I think you're going to see an increase in consumer sentiment at the home buyer level, even though the consensus is it's going to go down. Number 4, odds of a deflationary recession or depression have just increased dramatically. And by recession or by depression, I mean, 1929 style depression. This is not a sure thing right now. And by the way, deflationary recession is the politically correct way of saying what we call stagflation. We don't want to be in that. That's really bad for a long period of time. The 5th thing is you should watch the Federal Reserve. They'll give you clues as to what they're going to be doing. The new rate increase, decrease, or whatever they're going to do happens, I think, the 21st, next week. And so we will keep you guys apprised, but keep your eyes on any news regarding the Fed because they control the key to this whole thing. They do the wrong thing, we fall off the cliff. They do the right thing, we at least live to fight another day. So we will let you know. We'll see what's going on. As always, though, there's always money to be made in the real estate business. It's one of the 5 ways that you can survive in a depression, recession, stagflation, that kind of thing. So it is still, in my opinion, the best play in the game. Personally, we are buying more properties and we're rehabbing more properties and we're flipping more properties than we have in the last few years just because we can. And it is still a great profitable business at this point in time. So anyway, that's it for news you can use today. Okay, thank you for watching. If you get a minute, I would love to hear your comments about what you think of these videos. Feel free also to put in any topics down here in the comment section, things that you'd like to hear me discuss. Any questions you want, go ahead and put in here. We'll make sure we get a video on it when we get time. And as always, please like and subscribe. Hit that ring the bell button as well to get notified every time there is a new video. Thanks a lot, everybody.